Now, we'll be moving on to the single column cash book. Illustration number 1. So here we have a receipts and payment, like it's very simple. Cash book. Cash book. From the following transactions made by Mrs. Kunitha Traders, prepare the single column book, cash book. So in the books of Kunitha Traders, I am going to prepare the cash book, that too single column. So cash book. Cash book will always be in the debit side. We will name this being receipt side in default, and in credit side we usually call this being payment side. Yeah, of course, payment is nothing but credit, receipt is nothing but debit. That way also you can understand by default. When it comes to the subsidiary book, we won't call that being the debit and credit, right? Now, in this cash book, what are the receipts are there? No, by way of cash will be posted in the receipts book, receipt side. In the case of payment, that will be posted in the payment side. That's all. Whenever there is the opening balance, that will be started with the balance carried on, or sorry, balance brought on. Usually cash book will have the debit balance, so the balance will be in the debit side to balance brought down. We usually start with this one, balance brought down. Let's now continue posting the items available here. September 1, cash in hand being 40, which is nothing but the existing balance available. That will be the balance brought down. First of all, we have to post that here. In the receipt side, 40,000 rupees. In the receipt side, 40,000. On 2nd September, deposited into the bank. So as we confine our preparation with the single column cash book, we will be posting only items related to the cash. We forget about the other account. So the other account will be here bank. We never mind about the bank posting here. Deposited into bank. Automatically the balance in the cash book will be reducing, or cash box is reducing. So it will be a part of payment side. So in payment side, so by bank account, by bank account. This value being 16,000. On 4th September, received from Puneet in full settlement of the claim of rupees 12,000. From Puneet, we supposed to receive 12,000 rupees, by received only 11,700. So in the receipt side, we have to write the Puneet's name. We received it from Puneet. In the amount column, we have to post 11,700. Never mind about that 300 rupees discount now allowed. That discount allowed will not be recorded to be, not required to be recorded here, as the cash book is only single column. If it is being double column, we can have one more column where that difference, 12,000 and 11,700, 300 rupees being the discount allowed, could have been posted. But here, of course, it's not required. On September 5th, cash paid to Rukmani in full settlement of claim of rupees 7,000. So we have made the payment, the real payment to be made to Rukmani as per the balance is 7,000, but we paid only 6,850. The difference between these two is discount receipt. Again, never mind about that. So I'll post that value here, Rukmani. By Rukmani. Right. This value being 6,850. 6,850. On 6th September, sold goods to Sudhir for cash. Sold goods for cash. Immediately we get this money, receipt side. We never mind about the name here. Once the cash transaction is there, the party's name is not required at all. So in receipt side, I'll put the value 14,800. 14,800. Okay. And in description, you have to write sales. Party's name is not a matter. On same date, 6th September, paid quarterly insurance premium on policy for proprietor's wife. Come on. This value should be in which side? In the payment side, 2,740. Come on, tell me, what are you going to write in the description? Huh? Drawings account. Okay, whatever the payment may be for the owner's requirement, personal requirement, everything will be grouped in drawings only. Okay, if the money goes out from the business to the owner's pocket, that will be always named as drawings. Whether the owner uses it for whatever the purpose is not a matter for us. Rather than I give it to the owner and he spends, the owner directs me to directly settle that money for the owner's personal expenses. If I am making any payment for the owner's personal expenses, never mind, it is also drawings, because it's routed through the directions of the owner, and the payment is used for the owner's personal purpose. Any payment is meant for the owner's personal purpose will always be named as drawings only, should not have any confusions. Is that okay? The description matters here, drawings. On 7th September, purchased office furniture. Purchased office furniture, and then there should be a payment. So in payment side, office furniture, office furniture. Right. This value being 8,000. This value being 8,000. And the same date again we purchased stationery, paid cottage. These two again being the payment only. I put that value in the payment side as stationery and cottage. Am I going to write the purchases? No. So I am going to write that as furniture and stationery only. Stationery only. So stationery here. Okay. So we have purchased office furniture and stationery. All these things are named in the same, office furniture and stationery. Sometimes if the goods are purchased for the resale, then that may be named as purchases. But here it's not goods. The office furniture is for the company's personal requirement. Stationery is for the personal consumptions, company's official consumption, whatever it may be. Should always be charged in the same name, stationery. Count here, the value being 1,700. The value being 1,700. Is that okay? Hope so you couldn't understand. And 10th September, paid Kamal, discount allowed by him 200. We never mind about the discount. The original payment made to Kamal is 6,800 net of the discount. Should be posted in the payment side, Kamal. Payment side, Kamal. By Kamal. The value being 6,800. 6,800. On 11th September, received from Gurmeet, discount allowed to him 500. Never mind that. So we have received. So put the value 14,500 in the receipt side. In description, the name of the party from whom we received should be recorded. So Gurmeet. Gurmeet. Yeah, I missed the cottage. Okay, get back. I will get back. This is Gurmeet is 14,500. I have to post the cottage also, which is 120 in the payment side. So cottage. Cottage. This value being 120. Preferably the cottage should be ahead of Kamal. Okay. As per the date wise, we have to record this. And September 12th, amount withdrawn for office hold use. Amount withdrawn. So you are withdrawing from the bank to official purpose. The money will come from the bank account to the office cash box. We are preparing this cash book only for the office cash box, right? So this money comes to your box. Put that value in the receipt side. Bank. The amount comes from bank. Okay. Okay. Oh, household expenses. Amount withdrawn. Okay, sorry. Yeah, drawings upon that. Household use. Personal purpose. Then it is always drawings. In the payment side, we have to name this being drawings. The value being 5,000. Already we have one drawing and it is also similar to that one. So here is 2,740. The same kind is here also applicable. On 14, electricity bill paid. Electricity bill. Okay. Electricity bill. The value being 1,160. 1,160. On 17, goods sold for sales. Sorry, cash. Then it's a receipt. So in receipt side, sales. The value being 23,000. 23,000. And then on 21st September, bought goods from Kamal on cash basis. So you purchase from Kamal, and that too cash basis means Kamal's name is not important. We have paid the money immediately, the party's name is not required. So in the payment side, we have to post the value, which is 17,000. In description, we have to write the sales. Sorry, yeah, correct, sales, not the party's name. And 24th paid telephone charges, 26th paid postal, 28th paid monthly rent, 29th paid monthly wages and salary, and bought goods for cash. The entire set will be only the payment. So I'll put all this value in the payment side one after one directly. So one is telephone charges paid, telephone payment, the value being 2,300, and 520 being postal charges 520, and rent paid 4,200, wages and salary paid, the value being 8,250. Purchases, bought goods, right? So then in description I have to write the purchases account 11,000. The last transaction on 30th September being sold goods for cash 15,600. So in the receipt side, sales being 15,600. Now total this, where, okay, this one is purchases, sorry, I stand corrected, this one is purchases. Now come on, total this. In the receipt side, the total being 1,19,600, and you will get the balance. So balance carried on here being, hope it is 27,960. Verify this and let me know. And I'll rewrite here being the balance brought down 27,960. Okay. Cash book. And of course, the left hand side is receipts and right hand side is payments. Okay. One column is for bank, another column is for cash. Receipts in cash, receipts in bank. Bank and cash. Now let me start posting here. So we have the opening balances should be now recorded in the debit side or receipt side as opening balances to balance brought down. In bank, the value being 10,000. In cash, the value being 15,000. Correct me if I am posting wrongly immediately, right? Then on 3rd August, paid insurance premium by check. There's a payment that too by way of check. So by insurance premium, the value being 4,200, by check. On 8th August, cash sales 22,000 rupees and cash discount 750. I'll put the value cash sales here. Okay. Receipt side, sales. The value being 22,000 by way of cash. Don't worry about that discount now, because we confined our preparation with the bank and cash column only. On 9th August, payment for cash purchases 21,000 in payment side, purchases purchases, that value being 21,000 by way of cash. I assume that the payment by way of cash, not by check. Forget about the discount in this case. And August 9th, cash deposited into the bank. So this is a contra entry. Contra entry represents the two transaction, means record of the transaction in both the side of the same ledger. So cash book is one of the ledger, like I'm going to post in the both the side. One is in the receipt side, another is in payment side. So cash deposited in bank. Okay. For the bank, it is a receipt. For the cash, it is the payment. For the cash, it's a payment. Under the cash, I name this being bank. Under bank, I name this being cash. When you open the cash account, always the description will not contain the cash account. If the description is bank, if the account is a bank account, the description should not be bank. That's how you can remember. Just to verify, when you open the receipts, means a rent account or purchase account, under the description, okay, you write other than the purchases only. That logic you need to keep in your mind. So when it comes for the bank column, in description you should not write the bank. So the other one, cash account, can be recorded. I can represent this as being contra by stating a C symbol in both the side. Okay, C symbol in both the side. This will be available in ledger folio column. This will be available in ledger folio column. Anyhow, I am not going to open that. If I open a ledger folio column, in that column you have to put that C. Already I explained the meaning of ledger folio while teaching you the journal entry. After posting the journal entry, from the journal entry, journalizing, from the journal entry you will post that in the ledger. Now my question is, in which page of the ledger book contains this posting? To refer that, I will have the cross reference number. Rent account in the journal book goes to 5th page of ledger, means I will put the 5 in the ledger folio of the journal book. Ledger folio of the journal book. Similarly, it's also journal entry. This is also, the cash book is not account, it's only a journal entry, right? Subsidiary book. So from this, it should be transferable to the ledger account. It should be transferable to the ledger account. In which page of the ledger account will contain this particular item should be referred here. For example, this sales 22,000 rupees should be transferable to the sales account of some ledger book. Probably 5th page of the ledger book contains this 22,000, means I will write here 5. And when it comes to the contra entry, it will not be transferred to any of the ledger account because the other account is recorded in the opposite side itself. To represent the record is available on the opposite side, I use that C term here, contra. Where do I have the cross reference? You don't go for any other ledger, you just go and refer the opposite side. That's all. That's the meaning here. Contra will be posted only in the ledger folio. This value is 15. Now on 10th August, telephone bill paid. Telephone bill paid. Okay. Telephone bill paid. The value being 2,300 by way of check, right? So by way of check, so I'll post that in the bank account. 2,300 bank column. On 14th August, withdrawn from bank for personal use. Personal use always drawings. That too, the drawings happens from the bank balance. Okay, the value being 6,000. The value being 6,000. On 16th August, withdrawn from bank for office use. Then the amount to transfer from bank to cash box. For the cash, the money comes in, so it should be in the receipt side of the cash column, 14,500. In the bank column, it's a payment, so I put that value in the payment column. And under bank, I cannot use the same description, so the other account name is going to be used, which is cash. Under cash, I'm going to use the term bank. The other record is opposite side. Now, to represent that, I use the letter C here, contra. The other posting is available in opposite side. All of the transactions posted only once. Every transaction will be posted twice, one debit and one credit. As such, now we have posted only once. So double entry, we will transfer that to the ledger account. But when it comes for this contra, double entry is also over. So there will not be corresponding subsequent posting. Is that okay? Now, let's move on to the 20th one, August 20th. Received check from John in full and final settlement and deposited the same in the bank. Okay, 10,700. So we received and deposited to the bank the same date. In the receipt side, I put the name of the party who paid us, John account, the value being 10,700. I never mind about the discount because I have not opened that column. And 23rd August, received cash from Michael, discount allowed being 150, remove that, so 6,850 can be taken. 6,850 received from Michael, right? Receipt side, Michael, the value being 6,850 in cash box, 6,850. And on 24th August, stationery purchased for cash, stationery purchased in the receipt side, in the payment side, sorry, stationery, payment side, the value being 1,800, that too payment is in the form of cash, so put the value in the cash column. 25th, cartage paid in cash, cartage also paid, that too only in the form of cash, so in cash column the value being 350. And check received from Kumar, receipt side named Kumar, and the value will be posted in bank column. Now wait for this. An earlier case, in case of John, received check and immediately deposited into the bank, but in this case check is received from Kumar but deposit happens couple of days later. Check issued, received from Kumar, deposited into the bank. See, when you receive the check and not deposited immediately, then the receipt is assumed to be cash. Like on depositing the check into the bank, again it is assumed that the cash is deposited to the bank. The check in your hand can be equated with cash balance. Okay, check in hand can be equated with cash, right? So if I receive the check and deposit into the bank directly, of course the cash is not in your hand, directly goes to the bank, so bank account to party. When you receive the check and keep it for a couple of days, and if you are depositing later period, until you keep that check in your hand, that may be equated with the cash, so it's assumed to be cash receipt only. When you verify the cash box, you have the cash as well as check. When the auditor comes and inspects, show me the cash, you have 15,000 rupees something as per your books, then you can show, sir, 10,000 rupees cash counted now. Apart from that, 5,000 rupees check is there. So you can show that check is also equivalent to the cash to the auditor for the verification purpose. No, sir, I want to properly disclose, sir. In that case, you can properly disclose in the name of check in hand account itself. You can have a new account, check in hand account. It's a very rare. So usually we'll equate the cash and check in hand with cash. So in 25th, we have received the check but not immediately deposited. So the check is in your hand can be equated with the cash. So I am assuming this being cash. So the entry being we are receiving the cash. So in receipt side, Kumar account, the value being 4,500 posted in the cash box. On 28th, the same cash is deposited into the bank, right? So by the time it will be posted in the bank column's receipt side, and it will be payment side of the cash book, cash column. Is that okay? Under cash, it may be named as bank, and under bank, it is named as cash. And in the brackets, it will be contra. It will be contra. Contra only will have double entry for the transaction. So one is debit, another one is credit. Other than the contra, supposed to be completed while preparing complete illustration. So we'll see that in subsequent illustrations, right? Now, in August 31, check deposited on August 28, dishonored and returned by the bank. This check got dishonored and returned. While depositing the check, you might have passed an entry, no? You just reverse that entry. The check got dishonored. The entry being in the payment side, the check is going to be reversed. The amount came in, no, this is not realized, so reverse that. Okay. And what is the what is the item you are going to write in the description? Yeah, Kumar, you have to write Kumar, not the cash, Okay, we have received the cash from Kumar only. It's not cash check. We have received the check only from Kumar, but we have equated the check as cash. But that check is not matured, that check is now dishonored. Then immediately the party to whom, okay, we have to record here is the Kumar, the originator, Kumar account is now recorded in the description. And on August 31st, rent paid by check. Rent paid by check. In the payment side, rent. And that to the payment by way of check, put the value in the bank column, 4,000 rupees. 4,000 rupees. And 31st, paid wages to watchmen in cash. 31st, paid cash for postage. Two payments, I am going to post both. So one is wages payment to the watchman. Another one is postage payment. Both are in cash. So in cash column, 3,000 and 220 will be posted. Now come on, get me the total of these two columns. The highest total should be posted in the both the side. Hope the cash column will have always debit balance. So I will total the receipt side value. This value being 62,850. Correct me if I am wrong in this value. 62,850, and then the balance carried on here being 16,980. 16,980. And balance brought down. Balance brought down 16,980. Okay. Now similarly in case of bank, is there anything omitted? The bank shows, is it tallying? Now, come on. Bank balance 10, 15, 10,700. Okay. Which side?
Debit side cash. Debit side cash column 62,800.
Already cash is over. I want the bank column total.
40,200.
40,200 which side?
Bank side debit.
Bank debit 40,200. Okay.
Credit side 35,000.
30?
35,500.
35,500. Okay. What is the difference then?
4,700.
Yeah. Okay. So here the balance being 40,200. Debit side is higher. 40,200. And balancing figure being 4,700 for the bank column. 4,700. I'll write here as balance brought down 4,700. Is that okay? So this is also single column cash book only. Okay, single column or double column. Okay. Prepare bank column. Okay. Bank and cash. So double column cash book. Mrs. Laser Zone. So in the books of Mrs. Laser Zone, cash book, this will be ledger folio. First one is cash and second one is bank. Can I interchangeably use it, sir? Yeah, of course you can use it, no problem. Ledger folio and cash and bank column. Cash and bank column. Under that, we'll start with the opening balances given in January 1st, where we have cash in hand, but in case of bank, we have overdraft in a reverse case. So, balance brought down. To balance brought down. In cash, we have 4,000 rupees, but in bank, we have negative. So, it should be posted in the credit side by balance brought down. Clear? This is inverse. 3,200 should be in the bank column. And on 4th, wages paid. Wages paid. In payment side, wages. I assume that the payment is by cash. So in cash box, 400. Cash sales, the amount is going to be received in receipt side sales. I assume the money is received in the form of cash only, 7,000. On 7th Jan, purchased goods by check. So, in the payment side, purchases. Further, the payment being 2,000 rupees. That too, for the 2,000 rupees check is issued. So, in payment side, 2,000. In payment side, 2,000. Is that okay? Purchased furniture for cash, 2,200. In the payment side, I name this being furniture. I name this being furniture. The value being 2,200 by way of cash. By way of cash. Cash paid to Rohit. Cash paid to Rohit. In the payment side, Rohit will be recorded. In cash, 2,000 rupees. And then cash sales, 4,500. Sales, in the receipt side, sales being 4,500. 4,500. Deposited into the bank. So money comes into the bank, 7,000 rupees, and that will be the payment for the cash box. Under cash, I name this being the bank. Under bank, I name this being cash. Hope so you could now understand. Now I represent that being contra. That value, the C should be posted in the ledger folio column. Bank charged interest on overdraft 200 rupees. Payment side, interest on OD. As already we are aware about that, this bank has negative balance. Bank balance is the negative. Then interest might have been charged. Yes, interest could have been received. So here the charge will be in expenses, or it should be posted the payment side. Paid telephone bill by check. So telephone bill paid. Telephone bill. This payment being 600, that too by way of check. So in the payment side, 600 rupees. Sale of goods and received check rupees 3,000 deposited in the same date. So we are receiving. So in the receipt side, sale and check is received and deposited in the same date. So directly you can post that in the bank column. Received but couple of days later, if you are depositing, then at the time of receipt it should be named as cash. Later on deposit to the bank, it will be contra entry. It will be contra entry. And paid rent, in the payment side, rent. The payment side, rent being 800 rupees. I assume the payment by way of cash only. Drew cash for personal use 500. Then in description, I have to name this being drawings, as it is for the personal purpose. Value being 500. And paid salary, 1,000 rupees. In the payment side, salary. I assume that the payment being by cash. So I'll put that value in the cash column, 1,000 rupees. And interest collected by the bank. Banker collected interest. I could have deposited somewhere. I could have invested somewhere in shares or whatever it may be, bond. From that bond, I am getting the interest periodically. That interest is directly collected by the bank as per the standing instruction. So interest collected. So in bank column, 1,700. Okay, this is interest on investment. Hope so you could understand. I have posted everything. Now I am going to close this. Right. The total of the cash being 15,500. 15,500. Here also 15,500. 15,500. Then the balance brought down here being balance brought down 1,600. Here balance brought down. Sorry, there it is carried on, here brought down 1600. And when it comes to the bank column, hope I will get again positive balance 11,700, 11,700, 11,700. We have the positive balance, started with the negative balance overdraft, ending with positive balance 5,700. 5,700. Is that okay? Now, I'm going to prepare, I'm going to post that into the ledger. Post them into the ledger accounts. Clear? Let's see here. How do I work out that? Now, ledger. Okay. I assume this way. This is ledger book. Okay. This one being the page 1 of ledger book. This is page 2 of the ledger book. This is page 3 of the ledger book. If I need, I will extend one more page. This cash book is everything is available within one page itself. One page itself. Right. Now, the opening balances and closing balances not required to be posted in any of the ledger, leave it. I have to start with the sales. I am going to open the sales account here. Sales account. In sales account, as this value in the debit side of the cash book, now it is going to be transferable to the credit of the sales account. In the credit side, I name this being cash. Buy cash. The value being 7,000. Is that clear? This is the process we have to follow. From the journal entry, you are able to transfer to the ledger now, right? But here I am going to transfer from the subsidiary books. What are the accounts available in the cash book? Just see if it is in the debit side, should be transferable to the credit side of the concerned account. Because for each and every transaction, we have completed one posting. Another posting is pending. Now the other posting is this one. So I have transferred there. This posting is over. 7,000. And now tell me, this is transferred to, this sales is transferred to ledger account, right? In which page it is transferred? As for your understanding, I mentioned this being the page number 1. So it is transferred to page number 1. Right, page number 1. And here, in sales account, you have journal folio. Journal folio. Now the question is, from where this 7,000 is taken? Number 1. Page number 1 of the journal book, go and refer that. So from there I have taken this one. That cross reference is recorded in ledger folio as well as journal folio. Is that clear? Again, one more sales is there, 4,500. I'll put that value here, cash. The value being 4,500. From where this one is arrived? From where did you get this? Okay, I got it from the first page of journal book. Go and see the journal book. The term folio is nothing but page. Page 1, 2, 3. Why do I use the term folio rather than page number? We could have used the page number, right? Journal page, ledger page. You are aware about that journal book will have single page like. When it comes for the ledger book, you have the double page. Right? In one page, you have the debit, another page is for the credit page. But the entire thing will be called as folio number 1. Is that okay? You will understand. This entire thing will be folio number 1. This is called page number. You don't call this being the page. This is absolutely page 2 numbers. 2 pages are there. But we'll call that being folio number 1. Folio number 1. Okay. The size of the folio will be different. It's not required to be the same page, equal page. If you are taking the A4 note, each and every page will be the same. But folio not necessarily the same. When it's being the journal book, each and every page may be different. When you go for a ledger, it will be 2 pages is equal to 1 page, like, right? You are posting that. So that's why it's called folio here. Now, where to post the cash are? Then another cash sales is also there, right? So I will post this one also here. Cash. Okay, bank. This value being 3000. Now cross reference. This is transferred to the page number 1. This is transferred from page number 1 of journal folio. Leave, here it is. Leave, here it is. Then let's go for the another account. Now my question is, can I open the cash account? Now remember, this cash column of the cash book is similar to the cash account. So we no need to open the cash account. This bank column of the cash book is similar to the bank account. So we are not opening these two accounts. What? Cash account and bank account not going to be open. See, predominantly when you are being an accountant of a company or any shop, what could be the majority transaction? Only the cash transaction, receipts and payment. If you are not going to open those accounts, then half of your workload is now reduced, right? Otherwise, if you are passing the journal entry for each and every receipts, you have to pass the journal entry, and then you have to post that to the receipts account of the receipt side of the cash account. But here, we are directly recording that in the receipt side and payment side, and we are not going to open the cash account. Half of the workload is over. That's why practically we follow only this one. We don't follow the entry model. So when you go for any Chennai Silks or whatever it may be, a big shopping mall, so many sales are there. For each and every sales, cash account debit to that item, cash account to sales, cash account to sales. It seems to be imposition, like, rather than they will maintain the complete book where they record only the sales. That's all. That summary will be enough. And they are not going to then post that to the ledger, because cash column is already is equal to the cash account. So cash account is not going to be prepared. Leaving that, rest of the accounts are going to be prepared. Now, this cash, do I prepare? No. Anyhow, it should have the 2 columns. No, where can I refer the other one, sir? The sales has gone to the page number 1 of the ledger, sir. Then what about this cash, sir? Where does it go? Don't search anywhere. It is available in the opposite side itself. So you no need to post that in any of the ledger account. See, contra refers that the another record for each and every transaction will have the 2 record, 1 debit and 1 credit. So one is here, another one is in the ledger. But what about this particular transfer, sir, from cash to bank and bank to cash? The other record is available in the opposite side. You go on, don't search in any of the other ledger. That's the reference number. We are using C in short. And now let's go for the interest. I am going to open the interest account. So interest account. In interest account, this value should be in the, as it is in the debit side, I have to post that value in the credit side, 1700. By bank. That's all. Reference will be folio number 1 here, number 1 of the ledger folio. Leave the balance, and now we'll go for the wages. I'm going to open the wages account in page number 2. As this value in the credit side, I have to post that value in the debit side to what? Cash. Now I'm going to introduce what? Journal folio here. This 400 is transferred to page number 2 of the ledger folio. This 400 came from the page number 1 of the journal folio. Hope you could understand the cross reference. 400, that's all. Only one item, right? So wages is over. Then we'll go for the purchases. So I will be opening the purchases account. In purchases account, 2 bank, to bank. This value being 2000, the journal folio being 1. Here this purchases is transferred to the page number 2 of the ledger. Is there any other purchases? No, only one purchases we have. Leave it. Let's go for the furniture. Furniture account. There, to cash, to cash. This came from page number 1, 2200. 2200. This furniture is transferred to the page number 2 of the ledger book. Now Rohit, I have to open Rohit account as a new one. Rohit account. Here in debit side 2000. Okay. Named as to cash. To cash. Came from page number 1. This is transferred to page number 3. Transferred to page number 3. Contra, you can forget it. So double entry is over. Now interest on OD. Interest on OD. Overdraft. 200 rupees to bank. This one came from page number 1 of journal folio. This is transferred to page number 3 of ledger folio. Then we'll go for the telephone. Telephone. 600 rupees. 600 rupees. To bank. To bank. Came from page number 1 and transferred to page number 3. Then rent. Rent account. Okay. To bank. To bank. 800. To cash. Okay. To cash 800. Okay. This value being 800 from page number 1 transferred to page number 3. Drawings account. Drawings account. To cash 500. Page number 1. Here it is 3. And finally stationery. Stationery. Okay. To cash. To cash, the value being 1000. Now you will be able to understand the application of ledger folio and why do we use the C also. When I use the term C, then it represents that further transfer will not be happening. Clear? Come on, make a note of it. So this is all about for Messrs. Advanced Technology. Advanced Technology Limited. Advanced Technology Limited. Receipt side and payment side. This is cash column. This is bank column. Cash column and bank column. Let me start with this illustration. So 1st December, we have balance in cash and bank of rupees 3065 and 6780. I'll just post that here in the receipt side. To balance brought down. To balance brought down. This value being 3065. 6780. 6780 in bank. Second December, cash paid to petty cashier. In the payment side, by petty cash, 1000 rupees. The petty cashier with this cash he spends for petty expenses. That's not matter for us now. Received check from Priya on 3rd December and 6th December the Priya check deposited into the bank. So on receipt of check it is now equated with the cash account. So the amount received from Priya, though it may be in cash, in check, it should be posted only in the cash column. So Priya. Okay. The value being 3000 in cash column. Then cash sales in the receipt side, sales value being 2000. 2000 deposited into the bank 1200. For the bank it's a receipt 1200. For the cash it's a payment 1200. Under cash I name this being bank. Under bank it is named as cash. In brackets it's contra. It is contra. Right. On 6th December, previous check deposited into the bank. It will now come in the bank account. 3000 rupees as the receipt. And in the cash, it's a payment like. Is that okay? So, under cash, it is bank. Under bank, it is cash. Again, contra. Hope you now understand why do you use the C here. Okay. So, in the previous illustration number 3, I have explained the reason of contra and how do I apply the ledger folio and all here. On 8th December, purchased furniture by check. So, in the payment side, furniture will be posted. Furniture, payment for furniture. That too by way of check. So, I had to post that value in the payment side, 6,500 in the bank column. Paid trade expenses. Paid trade expenses. In the cash side, cash column 400 rupees. Then cash sales. Money comes in, right? That too by way of cash. So in cash column, the value of rupees 9,000 is posted. Bank charges in the payment side, especially bank column, bank charges. I'll put just notations only here. Bank charges. The value being 300 in the payment side. Dividend collected by the bank. Dividend collected. So, dividend received. That too, the dividend is received by our banker, recorded in the receipt side of the cash book, especially bank column 1200. 1200. Is that okay? Paid electric bill. Paid electric bill by check. In the payment side, EB. The payment for that 600 rupees being by check. So, I will put the value here 600. Cash purchases again payment. In the payment side purchases. This value being 2000. That too cash purchases. So, I put the value in the cash column. Paid for advertising. In the payment side advertising. Value being 1000, as it's not clearly mentioned whether it's by cash or check. I assume this being the cash payment 1000. So, I'll put the value in the cash column. Goods sold and received by check 6000 deposited on the same date. Goods is sold and received a check and deposited on the same date. Then you no need to consider the check being cash. It is always cash, bank only. Right. So, sales. Goods is sold. Okay. Sales. The value received being immediately deposited into the bank. So, put the value in the bank column. Paid legal charges. In the payment side, we have to put the value being legal charges. Value being 500. Value being 500. Drew from bank for personal use. Then automatically it should be a drawings. That value should be posted in the bank column as it's drawings from bank. 2000 rupees should be in the bank column. Paid establishment expenses. In the payment side, establishment expenses. the value being 340 in the payment side, 340. And paid for printing of bill book, printing charges. And then the payment being 850, I assume this is paid only through cash. Paid insurance premium by check. So, insurance premium. The insurance premium value being 2150 in cash column. Okay, by check, sorry, it's in bank column 2150. And cash sales, we get the money. So, in the receipt side sales, the value being 7200 in the receipt side. Paid salary by check, so salary here, payment side. This value being 4000, that too by check, no, put the value in the bank column. Rent paid 3000 in the payment side, rent. I will put that value in the payment side, especially cash column 3000. It is assumed. By default, you can assume this way. Commission received by check and deposit on the same date. So, in receipt side, commission. That too, the receipt in the form of check and deposited into the bank the same date. So, put the value in the receipt side. Paid for charity by check. Charity payment is nothing but donation that is made by check, no. So, put the value in the bank column, 800 rupees. 800 rupees. Now, finish up tallying this. Yeah. Now, what is the value in the cash column? 24,265 in the debit side, 24,265. 24,265. Balance carried on being 10,975. 10,975. In bank column, I assume I get the balance only in the debit side. Okay. The total in the debit side being 20,680. Am I right? 20,680. The balancing figure in the bank column being 4,330. Very good. So, rewrite here as balance brought down. Cash column, it is 10,975 and 4,330. 4,330. Is that okay? See, not only cash and bank columns are open here, cash book. Apart from that, we have to post all these things to the concerned ledger account. So, I am going to put that in the ledger account also. Ledger posting. Right. Now, let's see here. I'll just start posting all these things one after one. Leave the balance brought down, opening and closing. Priya account is there, so in new account I will be opening that. I'm not going to consider the journal folio here, and the ledger folio is also not going to be considered here. If you want to understand that, refer the previous illustration. Priya in the debit side, no, so it will be posted in the credit side as cash. The value being 3,000. And do you have Priya anywhere? That's all. So, I am not tallying the ledger because the requirement in this question is just posting. You need to post. I am not going to tally this, so leave it. If they asked about the tallying, then you can tally, but I am not going to tally that here. Now, we'll go for the sales account. So, I open the sales account also. In sales account, credit side, buy cash, 2000 rupees. I just pick only the sales. Again, we have the sales at rupees 9000, the same cash. Again, another sales is also there through bank, value being 6000. Another sales also there, cash, value being 7200. So I have completed the posting of sales. Contra will not be posted anywhere. You just put the tick mark and leave it. Double entry is already over. One posting is the receipt side, means the other posting is the payment side. So automatically eliminated. Now dividend. Dividend. In the credit side, bank. In the credit side, bank. 1200. Now let's proceed further. We have commission. I open the commission account now. By bank, because the receipt is in the form of check. So bank. Payment for the petty expenses. So petty account, petty cash account. Okay. As the value is in the payment side, means credit side, it should be posted in the debit side of the petty cash account 1000, named as cash account. To cash account. Is that okay? Furniture account also comes as a new one. So furniture account. To bank. The payment for furniture is made by way of bank. Check 6500. Only one transaction. Next one is trade expenses. Trade expenses also paid by way of cash. So to cash rupees 400. Then bank charges. Bank charges. 300 rupees should be to cash. Sorry, to bank. The auto debit, right? In our account, it will be automatically charged by them. EB payment. The electricity bill payment is also by way of check. So I'll put that value here by to bank. The value being 600. Now purchases there. Purchases. For the purchases, the payment is by way of cash or to cash, the value being 2000. Now verify, is there any other purchases? Of course, we don't have any other purchases. Leave it. Then the other account being the advertisement here. Advertisement to cash. For the advertisement, the payment being to cash rupees 1000. Legal charges. Legal charges to cash. To cash, the value being 500. Still we have further account. Now, drawings. I open a new account called drawings here. In drawings, in the debit side, bank account to bank. This value being 2000. Establishment expenses. Establishment expenses to cash. To cash 340. Printing. Printing to cash, the value being 850 in the debit side. Insurance premium. Insurance premium to cash. To cash. Sorry, bank. The payment is by way of check. So bank. To bank, the value being 2150. Salary 4000. Salary 4000. To bank, that salary is also paid by check, so to bank. Rent account paid by way of cash, so to cash, the value being 3000. Donation 800 rupees, that to the payment by check, so to bank. I just posted, not tallied. Hope so you could now understand how to post from the cash book to the concerned ledger. Is that clear? Book and post them to the ledger accounts for the month of September 2014. So I had to open purchases book of high tech fashions here. Messrs. High Life Fashions. High Life Fashions. Start with purchases book. The purchases book could be named as a bought book, also the other way. This book is for recording the credit purchases only. Purchases means purchasing the item for resale for a margin. That one only will come here. Any purchase of assets or consumable will not come here. Okay. If I purchase any asset, that will be charged in the same assets account only. Okay, understand that. Purchases account. In the case of cash purchases, it may be recorded only in the cash book. Already we have seen. In the previous illustration, we have opened the double column cash book also. In case of cash purchases, by either paying cash or check, could be recorded only in the cash book. If it is being credit purchases, the name of the party is the matter. I am going to record that in the purchase book separately, as it will not come in the receipts and payment. And that too only the purchases. Purchases means purchasing the item for the sale purpose. Purchasing an asset is for the long-term usage, will not be coming under this case. Right. So I'll open the purchases book as well as purchase return book. Purchase return book. Okay. This purchase return book is also return of the purchases in credit. Now, 1st September 2017, purchase of the following goods on credit from Mrs. Ratna Traders as per the invoice number 714 is there. 25 shirts at rupees 300. If you multiply these two, what is the total value? 7,500 for the purchasing shirts. In case of pant, 20 into 700, 14,000. So the overall value being 21,500, and there is a trade discount that should always be subtracted. 2,150 should be subtracted. Then 19,350 will be the final value. The 19,350 should be payable to Mrs. Ratna Traders as it is in credit. If it is being cash, then it may be posted in the receipts payment side of the cash book. As it's a credit, it should be separately recorded in this purchases book. So I'll record here Mrs. Ratna. I have to name him. I have to record the name only. So Mrs. Ratna Traders. Ratna Traders. The value being 19,350. September 8th, purchase of following goods on credit from Mrs. Bombay Fashion House as per the invoice number 327. 10 fancy trousers at the rate of rupees 500, then total being 5,000. 20 fashion hats at rupees 100 will be 2,000. Total being 7,000. And 5% trade discount is there, you can subtract that. So trade discount will not be accounted anyway. Okay, that's only a nominal amount. So remove it. Nominal amount means it's a name shake. You are not going to record that anyway. 6,650 is the ultimate value. Okay, the party here is Mrs. Bombay Fashions. Mrs. Bombay Fashion. Right. Bombay Fashion. Fashion House. This value being 6,650. On 10th September, goods returned to Mrs. Ratna Traders. Okay. As per debit note number 102, 3 shirts at the rate of rupees 300 means for shirt the overall value being 900, pant 1 into 700, 700 rupees, the overall purchase price being 1600, and of course there is a trade discount of 10% should be subtracted. Net of trade discount being, okay, net of trade discount being 1440, 1440. It's a purchase return, so put that value in the purchase return. Mrs. Ratna Traders, Ratna Traders, this value being 1440. September 15, purchase of the following goods on credit from Mrs. Zolta Fashions. 10 jackets at the rate of rupees 1000, so this is 10,000 rupees. 5 plain shirts at rupees 200, so this is around 1000 rupees. Okay, 10,000 plus 1000, 11,000. From the 11,000, trade discount should be subtracted, the trade discount being 15%, this value being 1650. Am I right? 1650. If I subtract this, 9350 is the final value. So put that value in the purchases book. Mrs. Zolta Fashions, Zolta Fashions, this value being 9350, 9350. 20th September, 20th September, purchase the following goods on credit from Mrs. Bright Palace as per invoice number 1076. You can have one more column for recording the invoice number also. Okay, so I skip that, you can write that on also. So 10 fancy lenga at rupees 2000, if you multiply, then the total value being 20,000 rupees. Trade discount being 5%, so which is 1000, you have to subtract this, then the final value being 90,000. Right. Mrs. Bright Palace, Mrs. Bright Palace. Okay, the value being 19,000, 19,000. Now on 24th September, goods returned to Mrs. Bombay Fashion House. As per the debit note number 103, 2 fancy trousers at the rate of 500 per trouser, 1000 rupees, and 4 fancy hat rupees 100 per hat, 400 rupees. So the overall value being 1400, and you have to adjust the trade discount also. Right. Bombay Fashions. Here is this. Okay, here is this Bombay Fashion. They have given the 5% discount, right? So while returning, the same 5% discount will be reversed. So that will be 70 rupees. So 1330 will be taken. Okay, Mrs. Bombay Fashions. If the trade discount of 5% is not given, means you have to compare with the previous transaction, and from there that right discount should be taken. So here Mrs. Bombay, Bombay Fashions, Bombay Fashion. This value being 1330, 1330. On 28, goods returned to Mrs. Bright Palace as per the debit note number 105. 1 fancy lenga at rupees 2000, so 2000 rupees. 1 out of that, probably it might have been purchased from Bright Palace. Bright Palace is on 20th September. Out of that purchase, 1 is returned, where the trade discount is also be adjusted, so only 1900 will be the value. Right. So I'll put the value here. Mrs. Bright Palace, Bright Palace. Now 1900. The total of this value, purchases book total being 54,350, and purchase return total being 4,670, 4,670. Now I am going to post these things to the ledger. Okay, see how are we planning to post this into the concerned ledger. Now ledger book, ledger book. in ledger book, the total of purchases book should be transferable to the purchase account. Should be transferable to purchases account, right? Purchases book is different, purchases account is different. In that purchases account, you have to post this value, sundries from purchases book, named as sundries from purchases book, to sundries from purchases book, value being 54,350. See, when you want to post from the cash book, you are going to do only once, because the cash column is equal to the cash account, bank column is equal to the bank account. So you don't need to open that. You don't need to open that. Clear? But when it comes to the purchases book, it's not having account stale. So you have to do 2 times record. The total will go to one account and inside item will go to the other account. Total item will go either debit or credit. If it is being the purchases book, the total will go to the debit side and inside item will go to the concerned account's credit side. So now I have posted the debit side of the purchases account because purchases and expenses debited. Internal items like Ratna, Bombay, Zolta, Bright. You have to open all the 4 accounts there. It should be posted in the credit side. Right. Now let's see here. Ratna account by purchases. Okay. This value being 19,350. Bombay Fashions. By purchases, the value being 6,650. Zolta Fashion. By purchases, 9,350. Bright Palace. By purchases, 19,000. When it comes for the purchase returns book, the total will go to the purchase return account credit side. So purchase return account. Account is different from the book. For total 4,670 should be in the credit side by sundries from, named as sundries from purchases return book. As this has gone to credit side, then internal item should go to debit side of the concerned account. Ratna traders will go to the Ratna traders account, that too in the debit side, to purchase return. This value being 1,440. And Bombay Fashions, in Bombay Fashions to the debit side, to purchase return. The value being 1,330. Bright Palace, in Bright Palace to purchase return. This value being 1,900. Hope so you could now understand posting the ledger from the subsidiary books, especially purchases and purchase return book. The same pattern will be followed for what? Sales also. Okay, come on, finish up copying this. And sales return book of Messrs. Vinith Stores. So in the books of Messrs. Vinith Store, we have to open sales and sales returns book. So sales book. Another one is sales return book. Sold goods on credit to Mrs. Rohit Store as per invoice number 325. You can have a column for referring this invoice number. 30 kids books at rupees 60 each, 1800. 20 animal books at rupees 50 each, 1000. 2800 rupees, at which it is sold to Rohit. So in sales book, 50 into 20. So Rohit account, Mrs. Rohit account, Rohit stores. The value being 2800. December 5th. December 5th. Again there is a sales, sold goods on credit to Mrs. Meera stores as per the invoice number 328. 100 into 12, 1200 for greeting cards. 50 into 50, 2500 for the musical cards. 3700. 5% discount on that. How much is that? Okay, 185. See, if I subtract that, the balance being 3515. Meera stores. Meera stores. Okay. 3515. 10th one. Sold goods on credit to Mrs. Meha Stationaries as per invoice number 329. 10 writing pads at rupees 20. Okay, the value being 1000. 50 color books at rupees 30. If I multiply, then it is 1500. The overall value being 2500. From there, I have to say again one more thing. 20 ink pads at rupees 16. 320. Am I right? So the overall value being 2820. So Meha Stationery. Meha Stationery. Entire division is all about stationery and books. So Meha Stationery. Stationers. Okay. The value being 2820. On 15th December, goods returned from Mrs. Rohit store as per the credit note 201. Mrs. Rohit store. 2 kids book at rupees 60 each, 120. 1 animal book at rupees 50 each, 50. The total being 170. That will be now posted in the sales return book. Okay. Rohit stores. Rohit store. The value being 170. 170. 19th, sold goods on credit to Mrs. Haba Traders. 100 cards book at rupees 10 each, total 1000. 50 notebooks at rupees 35 each, 1750. Total being 2750. Okay. And the discount being 5% on that, 137.5, 5%, right? $137. Okay, 2750 into 5%. 137.5. If I subtract this value being, okay, $100 into 10,000 is correct. So 50 into 35,750 is also correct. Once again, Okay. Then the value being 2750 minus 137.5, this value being 2612.5. 2612.5. Okay. About traders. About traders. I just cross verified with the text. There is a small error. They have considered this being 50, not 35, 30. That's how it's solved in the text. Okay then. 2612.5. As per the question, I'll just proceed. In 22nd, goods returned from Mrs. Megha Stationery. 2 color books at rupees 30 means 60 rupees is returned from Megha. Megha Stationery. Megha Stationery. Stationers. Okay. The value being 60. On 26th, goods sold on credit to Mrs. Bharati Stores. 100 greeting cards at rupees 20. 2000 rupees. 100 fancy envelopes at rupees 5. 500 rupees. The total being 2500. The total being 2500. So, Bharati Stores. Bharati Stores. Okay. This value being 2500. And 30th, goods returned from Mrs. Abba Traders. 20 card books at rupees 10 each. 200. 5 notebooks at rupees 35 each. 35 into 5. 175. 375. 375. 5% discount on that being 18.75. If I subtract this value being 356.25. So, about traders. About traders. In the text, they have considered this being 30 on solution. Right. 356.25. 356.25. 356.25. Okay. Now get the total of these two. Sales book total being 2800 plus 3515 plus 2820 plus 2612.5 plus 2500. How much? This one 14,247.5. Sales return book being 170 plus 60 plus 356.25. 586.25. Now, I have to open the ledgers here. So, sales account, ledger book, there, sales account. The total should go to the credit side. So, buy sundries from sales book. Value being 14,247.5. Is that okay? Now, internal item should go to the debit side. This one will go to the credit side. The internal item should go to the debit side of the concern account. Rohit store. There in debit side 2800 to sales return. SR. I just put the term as SR. Mira stores to SR, sales return. Sorry, sales, not sales return, sorry, sales. Sales, sales. 3515. 3515. Mega stationers. Mega stationers. Two sales. Two sales. The value being 2820. About traders. About traders. Two sales. 2612.5. Bharti stores. Bharti stores. Two sales. 2500. Now, sales return book, the total will go to the debit side. Internal item should go to the concern accounts credit side. So, sales return book, return account, sorry. In the debit side, 586.25 named as to sundries from sales return book, SRB. In Rohit, by sales return, SR 170. In Meha stationery, by sales return 60. In About traders, by sales return 356.25. Is that okay? That's all. Posting is also over. Come on, make a note of it. Like we don't have the purchases without CGST and IGST or SGST. So you have to understand how to incorporate all these things. Now, purchases book. Purchases book. And then purchase return book. Purchase return book. Purchase return book. Right. Purchased from Mrs. Ramakant, Delhi, 20 televisions at rupees 15,000 each. From whom? Ramakant, Mrs. Ramakant. Okay. We have purchased TV, television, 20 televisions at rupees 15,000 each. Total being 3 lakhs. And 5 DVD players at rupees 10,000 each. DVD players. 5, 10,000 each, 50,000. The overall value being 3.5 lakhs. And the trade discount is there, that should be subtracted, which is 10% on this, 35,000. Then the ultimate value being 3 lakhs 50,000, 15,000. Right. The last line, rate of GST applicable on the above purchases. CGST means 9, SGST 9, IGST is nothing but summation of these two, which is 18%. IGST will be applicable only when the sale happens from one state to another state, between the states, interstate sales. In the case of CGST and SGST, that will be applicable for the intrastate sale. Here, purchased from Ramakant, Delhi. Right. I don't know whether IGST is there or not. In the solution, it is assumed everything is subject to intrastate only. Intrastate only. In the case of intrastate, we don't have what? IGST, we don't have. Okay. Probably the first one, is there any information regarding that? So the first one, 5 will be intrastate. 20th, Haryana. See, here we are working for a person of Delhi. That information is silent. That's the problem. So, buyer is also Delhi, the person who supplies is also from Delhi, then this is intrastate. Intrastate means automatically we have to apply CGST and SGST, right? Now 3,15,000 will be the value. Find out the CGST and SGST. CGST, SGST. Yeah. CGST is 9% and SGST is also 9%. Instead of that, if IGST is applicable, then 18% will be taken. So for the 3,15,000, 9% is 28,350. Am I right? So 28,350 is the CGST. 28,350 is for SGST. Nothing is for IGST. The first one is also over. On 7th August, 2 television returned to Mrs. Ramakant, Delhi, found defective. So, Mrs. Ramakant, right? TV. How many TVs returned? 2 TVs. Each TV costs us rupees 15,000. Okay. Though value is given or not, we can refer from the previous one. 30,000 rupees and trade discount is also applicable. Trade discount, just take the value from here. 3,000 rupees, 27. Naturally, CGST and IGST, SGST should also be written. Now, what is the value of that? 9% on this, 27,000. 2,430 and 2,430. IGST is not applicable. On 20th, bought from Mrs. Same Electronics, Haryana. We are in Delhi, purchasing from Haryana, then it is interstate. In the case of interstate, IGST will be applicable. Right. Mrs. Same Electronics. Okay. And washing machines purchased. Number of washing machines being 10 and the price per washing machine 5,000, so 50,000. Televisions, 5 numbers, per television being 25,000. 1,25,000. And total being 1,75,000. 1 lakh, oh, trade discount is also there. So 1,75,000. The applicable trade discount in this case being trade discount 5%. 8,750. Then the net value being 1,66,250. 1,66,250. And for that, CGST and IGST will not be, SGST will not be applicable, only IGST is applicable, which is at the rate of 18%, 29,925. That's all. This total will go to the sales account. The total of this being 4,81,250. This will go to the purchases account, not the inclusive of tax. Exclusive of tax will be the purchase value transferable to the purchase account. And this will go to the input GST account 28,350. This is also 28,350 and final value being 29,925. Here purchase return book being 2,70,000. This will be 2,430. This will be 2,430. Of course, we don't have the IGST. So I can open the purchases book, purchases account. Let's see here. If I open purchases account, of course not asked in the question, this 4,81,750 will be posted in the debit side. So 4,81,250 as sundries from purchases book. Okay. Then this 28,350 will go to the input CGST. Input CGST. Is that okay? Where? That is also in the debit side because it's an asset for us. It's an asset. Isn't it? While purchasing, any GST is paid can be recoverable from the government. So it's an asset. Right? GST paid on purchase can be recoverable asset. On sale, you have to collect and pay. It's a liability. So it's an asset. So I'm going to debit it here to 28,350. Okay, that's all. Come on, finish up copying this. Rest of things not required. I just guided you where it will go. This will go to the debit side of the concern input GST account, right?
So total plus 70,000 27,000.
Yeah, total being 27,000. Wait, okay. Total 27,000. Clear?
These are purchases.
Any doubts here? Any wrong? Error? Okay. Finish up copying this. The first sales is to Rahul Brothers of Delhi. Moves from Rajasthan to Delhi. Then this will be intra-state sale. IGST will be, sorry, interstate sale. IGST will be applicable. And then the third one, August 18, Jaipur, also in the same Rajasthan. So this will be intra-state sale. Then here CGST and HGST will be applicable. So Mrs. Akash, Rajasthan. Okay, it's from Rajasthan. Sales book and sales return book. Sales book and sales return book. Right. Now, as per the first transaction, 25 shirts at rupees 300, 7,500, 20 pants at 400, 14,000, total being 21,500. 8% should be subtracted. That value being 1,720. The ultimate value being 19,780. Here, Mrs. Rahul Brothers. The value being 19,780. And CGST, SGST and IGST. The rates being 2.5% only. The rates being 2.5% only. So CGST and SGST being 2.5%, IGST should be summation of these two, 5%. Okay, 5%. So on 19,780, 5% is means 2.5% being 253 for CGST, another 253 for HGST. And 10th August returned 5 shirts to Mrs. Rahul Brothers. In that, there is a return, Mrs. Rahul Brothers. And 5 shirts, per shirt rupees 300 rupees. Multiply these two, so 1,500. Discount at the rate of 8% is applicable. 120 on that, so 1,380 will be the net of straight discount. 1,380. And CGST and HGST are going to be returned. That value here being, this is interstate, no. First one. No, okay. So sales return is 1,380. Okay. For 1,380, 2.5% being 34.5. 34.5. 34.5. 34.5. And then sales to Mrs. Kishan Traders. Okay, Mrs. Kishan Traders. Jaipur. The others. Oh, first one is Delhi, no? Then it is inter. This one is inter. Because Rajasthan sale is in Delhi, then this is inter and intra. As first one is interstate sale, the total should be only in IGST. Come on. Calculate 5% on 19,740, 780. 989, I think so. 989. On return 1,380, for that 5% will be 69. And the last transaction is Jaipur, which is intra. Intra means we need to use CGST and HGST. Mrs. Kishan Traders. Kishan Traders. Okay. 10 jackets at rupees 900, 9,000. 5 plain shirts at rupees 400, 2,000. Total being 11,000. Discount being 8%, 880. Then the ultimate value being 10,120. 10,120. Okay. 10,120. This will have a CGST and SGST. CGST and SGST at the rate of 2.5% each. 10,120 into 2.5% being 253. 253 for CGST. Another 253 for SGST. Now total this 29,900 rupees. And CGST 253, SGST 253, and IGST being 989. Similarly here 1,380, the IGST returnable being 69. No CGST and SGST here. Is that clear? First one is inter. Rajasthan is the seller place. Delhi is the other state, right? One state to another state is called inter. One state to another state is inter. Is that okay? Within the same state means intra. And spend 50,000 for its installation. While purchasing any assets, any installation expenses for that will also be addable. So the total value being 5,50,000. Total value being 5,50,000. The salvage value of the plant after its useful life is, the useful life of 10 years is estimated to be 10,000. Record journal entries for the year 2016 and 17. Draw plant account and depreciation account for the first 3 years, given that the depreciation is charged using straight line method. Okay, and then the books of accounts closed on March 31st every year. The firm charges the depreciation to the assets account, right? So, amount of depreciation here being cost of the assets being 5,50,000 and scrap value of the asset being 10,000. After subtracting the scrap value from the cost, which is the depreciable amount, 5,40,000, and the life being 10 years. Under straight line method, no. So the depreciable amount should be divided by the life, so that you will get the depreciation, amount of depreciation. The amount of depreciation year after year being 54,000. So Year after year, you have to charge 54,000. Anyhow, you are going to prepare only for the 3 years. On 1st April 2017, 1st April 2017, asset purchase, right? The entry for that, asset purchase, the entry for that. What asset is this? Plant. Okay. Plant account debit to bank or cash. To bank or cash. You can interchangeably use this. Currently, we use bank account only. The value paid, the amount paid for this purpose is 5,50,000. 5,50,000. By the first year end, we have to depreciate this. The amount of depreciation by the end of first year being 54,000. That 54,000 is going to be adjusted in the asset account. See that the firm charges the depreciation to the asset account. Whatever the depreciation you calculate, that amount will be adjusted in the asset account, or this will reduce the asset's value. The other way is that depreciation will be accumulated in the provision for depreciation model. That's another one. It is going to be added to the provision for depreciation model. This is the first model where the depreciation is the loss of the asset's value because of the usage. Year on year, the asset loses its value by 54,000. That can be adjusted or deducted from the asset's value. That's one model. The other model, it will be accumulated in another account called provision for depreciation. As per the first model, by the year end, 31/3/2018. Okay. 31/3/2018. Depreciation is debited. Depreciation account debited to plant account. To plant account. This value being 54,000. Okay. On closing, whatever the nominal accounts we have should be by default transferable to the P&L account. So I will transfer this to the P&L account. Okay, for the first year. Now the entry being profit and loss account debit to depreciation. This value being 54,000. We have to prepare for 3 years. So I am repeating this year after year for the 3 years. Is that okay? Now, for the second year, it's only a repetition. The same entry will be passed for the next year also, 31/3/19. Again 31/3/20. You have to pass these two entry again and again for the another 2 more years. That's all. So as it is a repetition, I don't pass that. I leave it to be passed by yourself. Not only that, so we have to prepare the concerned assets account as well as depreciation account, the ledger account. Let me solve that also now. See here. Plant account. On 1st April 17, plant account debit to bank. The value being 5.5 lakhs. By the end of first year, 31st March 18, by depreciation, the value being 54,000. Year 1 is over. I will now close this 5,50,000. 5,50,000. From 550, 54 is subtracted to get the closing value, which is 4,96,000. Balance carried out. That will be transferable to the next year. 1/4/18 as to balance brought down. The value being 4,96,000. By the second year end also, we are repeating the same. The depreciation charged in the plant account every year, 54, second year and another year also. So the next year 31,319 by depreciation. The next year the depreciation is 54,000. 54,000. Every year the balance of asset is decreasing because of the usage. The value loss being 54,000 in this year. So year after year I am subtracting 54 to find out the closing balance. So 4,96,000. 4,96,000. Now the balancing figure to be transferable here being balance carried on 4,42,000. 4,42,000. Here 1,419 I start with balance brought down. Start with 4,42,000 in the third year beginning. By the end of third year 31,320 by depreciation. By depreciation. The depreciation here being again 54,000 because it's a straight line method. So year after year the depreciation being the same 54,000. Close this. Balance carried on 4,42,000. 4,42,000 and balance carried on being 3,88,000. Gets closed. Is that okay? Yeah, but I stopped here itself, right? Okay. Yeah, of course you can post that. Apart from that, we have to open the depreciation account also. Depreciation account is a nominal account. Charged in the depreciation means asset account and later it is transferable to the P&L account. That's all. Whatever the amount you subtract from the plant named as depreciation, ultimately transferable to the P&L account's debit side. Charge and transfer. That's all. Not more than that. So I am opening the depreciation account. Depreciation account. In depreciation account, the first year depreciation 2 plant on 31,318. 2 plant. The value being 54,000. By the end of first year, by default, the depreciation is transferable to the P&L account as on the same date, 31,318. By P&L account. We don't have any balances here because it's the nominal account. Always the nominal accounts are transferred to the P&L account and it's closed. There will not be any balance to be transferred to the next account, next year. Repeat the same for the year after year. For the next year, 31,319. The same 2 plant 54,000 and 31,319 by plant and profit and loss 54,000. This one is over. This one is over. The next year will be 31,320. 2 plant. Again the depreciation for the third year is also the same as it is a straight line method of depreciation. Whatever the depreciation you subtracted from the asset account is by default transferable to the P&L account as it's being the nominal account. We don't have any balances year after. Okay. Come on, finish up telling this. On October 1, 2016 and spent rupees 20,000 for its installation. Any charges incurred for installation like carriage in whatever it may be clubbed as a machinery only. So the machinery value is 2 lakhs. The firm writes up depreciation at the rate of 10% on original cost every year. So you have to calculate 10% depreciation on this. Record the necessary journal entries for the year 2017. Though they have asked only for 2017, we will try to finish up to the 3 years. And draw up the machine account and depreciation account for first 3 years, given that number 1, the book of accounts closes on 31st March every year, right? So we purchase the asset on 1st October, but the first year ends on 31st March. So automatically you have to calculate the depreciation from the date of purchase to the year end, or if the asset sold up to the date of sale only, you have to calculate. So in this class, in this particular illustration, we have to start the calculating depreciation, start calculating the depreciation from 1st October, and it ends with 31st March of the next year itself, right? 1st October 16 purchase, right? Further, the journal entry being machinery account or machine account debit, machine account debit to bank account, the value being 2 lakhs. Next one will be depreciation to be calculated only by the year end. Financial year ends on 31st March 17. Depreciation account debit to machine account, depreciation account debit to machine account, to machine account. The value being 10% on that, 20,000. Yeah, here it's only 6 months, 2 lakhs. Calculate for 1 year's depreciation, but this is eligible for only half year. Starts from 1st October, ends on 31st March, half year, 10,000. By the year end, whatever the depreciation amount is there will be transferable to the P&L account. So profit and loss account debit to depreciation. This value being 10,000. And next year, 31/3/18. Now it is eligible for full year's depreciation. The first year end. This asset is used for full year, so we have to calculate the depreciation for the full year. Depreciation account debit to machine account for 2 lakhs, 10% being 20,000. On the date, immediately this value will be transferable to the P&L account. So profit and loss account debit, to depreciation, the value being 20,000. One full year. First case, it's only for half year. Starts from 1st October to this date. Half year only there. Now from here to here, 1 full year is there. So we can claim the depreciation for 1 full year. Then the third year, 31/3/19. Calculate the depreciation for the full year here. Depreciation debit for full year, the depreciation being 20 to asset account, to machine account. The value being 20. Then this will be transferable to the P&L account. So profit and loss account debit to depreciation, 20,000. Now we can prepare a ledger account also for the machine as well as for depreciation. Okay. We'll start with machine account. Here is machine to bank. I skip the date here. To bank. The value being 2 lakhs. And here, by the year end, depreciation will be 10,000. Is going to be deducted from the asset account. So by the depreciation here, the value being 10,000 rupees. After subtracting this, the value of the assets being 1,90,000 only. So 2 lakhs. 2 lakhs after subtracting 10,000 rupees. The WDV value by the end of first year is being 1,90,000. Balance carried on. Rewrite here as balance brought down. So the balance brought down here being 1,90,000. 1,90,000. In the second year again, we charge depreciation of rupees 20. So by depreciation, the value being 20. After subtracting the value of the asset being 1,70,000 only. 20 is subtracted, now the value being 1,70,000. 1,70,000. Balance carried on. Balance carried on. Two balance brought down. Two balance brought down 1,70,000. And in the next year again, I charge another depreciation rupees 20 by depreciation 20. After that, the balance being 1,70,000. Okay, sorry, 1,50,000. 1,50,000. To balance brought down. To balance brought down. 1,50,000. We have to open the depreciation account. Depreciation account is very simple. Open and charge, and later it is transferred to the P&L account. So first year end, two machine 10,000. By the same time, it will be transferable to P&L account. So by P&L account 10,000, it's closed. Second year also you repeat the same, two machine account 20, and by P&L account 20. To machine account the last year 20, by P&L account 20. Is that okay? Yeah, come on, finish up copying this. For the purchase 18 plus 20, 2 lakhs. Installation charges will also be forming part of the assets value. And rate of depreciation being 10% and the method of depreciation being original cost method. But it is not going to be charged. It is not going to be charged in the asset account. The firm charges depreciation to asset account is not available here. But it is going to be accumulated in the provision for depreciation account. It is going to be accumulated in provision for depreciation account. Let's see here. On this date, at the time of purchase, the asset entry being machine account debit. Machine account debit to bank. To bank account. The value being 2 lakhs. The value being 2 lakhs. Then next 110, okay, 110. By the year end, 31st March 17, depreciation will be provided on this. Depreciation. Only for half year. Because it's purchased only on 1st October to 31st March, it's only half year. 2 lakhs into 10% for half year you have to calculate. This value being 10,000. 10,000. Usually the depreciation should be adjusted in the asset account, but here it is not so. Will be accumulated in the provision for depreciation account. Provision for depreciation account. As usual, the depreciation will be transferable to the P&L account. I am transferring that here. So profit and loss account debit to depreciation. To depreciation. The value being 10,000. This one is over. The next year repeat the same loss to entry again and again. That's all. 31/3/2017. Right. So I have a shortcut. I don't know whether it will be applicable for you. Is there such chances available for you? This is called cut and paste. Usually we'll do, sir, by seeing the friend's note. I'll change here. This is for 18. This value is 20. It's only cut and paste, right? This is for 19, 20, 20. The same entry I am repeating, that's all. Is that okay? First year for half year, second year onwards it's for full year. Second year onwards it's full year. Isn't it? Full year means the full value of 2 lakhs. Okay. One second. 2 lakhs, and second year it's fully used, 10% will be calculated, which is 20,000. Okay. Listen the lecture. I'll get back. Now let's see here. So first year amount of depreciation is 10. What is the amount of depreciation for the second year? 20. Third year? 20. The same I did. That amount is not going to be subtracted from the assets but accumulated in the provision for depreciation. If you prepare the ledger, you will understand. Let's see here. I am going to prepare the ledger. It's last two entry repeated again and again, similar to the other model. Only thing, the depreciation is not going to be charged to the asset account but accumulated in the provision for depreciation. Now the first one is machine account. First one is machine account. In machine, to bank. To bank. 2 lakhs. I don't do any other adjustment in asset account, so it remains the same year after year. Isn't it? It remains the same year after year. If you want to prepare, then you can prepare this way. First year 20, 2 lakhs. What is the closing balance? I don't pass any other adjustment here. So the year end, the value being balance carried on. 2 lakhs. This becomes the opening balance for the next year. Balance brought down. 2 lakhs. No adjustment carried over on this. So this becomes balance carried on for the next year. Isn't it? And third year, again it remains the same. In the beginning of the third year, 2 balance brought down. 2 lakhs. And this becomes balance carried on as it is. That's all. Because the amount of depreciation is not going to be adjusted in the asset account, the asset account will appear in the balance sheet as asset itself, full value. What about the loss of that asset, sir? That will be accumulated in the provision for depreciation shown in the liability side, or in the same asset side, in the inner column, we subtract that accumulated depreciation and put the value in the outer column. That way it can be worked out. Let's see here, provision for depreciation. Provision for depreciation. So here, provision for depreciation by depreciation, right? For the first one, by depreciation. This value being 10,000. That's all. If I close the first year, we get a balance carried on of rupees 10,000. That 10,000 becomes as opening for the next year. Opening for the next year by balance brought down. 10,000. Second year again, I am going to calculate the depreciation 20 for the full year. Provision for depreciation by depreciation. Now the accumulated depreciation is 30. Isn't it? The balance in provision for depreciation being 30 here. To balance carried on. To balance carried on. Transfer to the next side. So by balance brought down. 30. Again, third year depreciation 20. Then the balance could be to balance carried on being 50,000. The balance could be 50,000. How this will appear in the balance sheet? Though it is not asked in the question, you will understand in balance sheet. For the first year, machine being 200, provision for depreciation being 10. Second year, the machine will appear at 200. Provision for depreciation will appear at 30 because this is the balance carried on. The balance will go to the balance sheet. In the third year, machine will appear at 200. Provision for depreciation will appear at 50. And the net of this will be 190. The net of this being 170. The net of this being 150. That's the balance in the previous case. 190, 170, 150. Is that okay? You will get the same. Sir, why don't we subtract, sir? Why do I want to create that separately? If I ask that question, it's very simple. Depreciation is only an estimation. I'm not sure. How can you say that asset will be losing exactly this much of amount by the end of first year? It's a matter of an estimation, right? As it's a matter of an estimation, why do you then charge? You just keep it away separately. The original loss can be identifiable only on discarding it. On sale only you will be identifying. By the time adjust the provision, then beyond that if there is any differences, that will be treated as profit and loss on sale. So rather than adjusting that the depreciation directly from the machine account as it's only an estimation, we can accumulate that in a new account called provision for depreciation. Provision for depreciation. So one of the beautiful model. Then what happens in the depreciation case? Depreciation case is the same. Depreciation is rather than subtracting from the assets accumulated in the provision. And then the depreciation is transferable to the P&L account as usual one. So provision for depreciation here. Sorry, depreciation account. Sorry, depreciation account. In this depreciation account, first case, to provision for depreciation. Provision for depreciation 10,000, and this will be transferable to P&L account also. By P&L account 10,000. First year over. Second year repeat the same. To provision for depreciation 20. Depreciation is a nominal account. We don't have the balance at all. Whatever the balance we have will be transferable to the P&L account. And the last year means third year as per our provisions, our illustrations requirement. Provision for depreciation 20 by P&L account 20, it gets closed. It gets closed. Is that okay? On credit from Messrs. Ahuja and Sons and spent rupees 10,000 for its installation. Okay. Depreciation is provided at the rate of 10% per annum on written down value basis. You supposed to prepare only the machinery account here for the first 3 years. So you have to prepare for 3 years only machinery account. Let's see here in the books of Dalmia Textile Mills, Messrs. Dalmia Textile Mills, Dalmia Textile Mills. Okay, books. I am going to prepare only the machinery account. Machinery account. And the machinery is purchased on credit, then we have to take the party's name. Machinery account debit to Ahuja. Another 10,000 rupees is immediately installed. We assume this is immediately paid. In either way, you can assume. So, to Ahuja, 2 lakhs. I assume at least that installation charge is immediately paid. Bank. Depreciation will be provided on this value 2 lakhs plus 10, 2 lakhs 10,000 for the depreciation is provided by the end of first year, because the very first year it is used completely. From 1st April onwards it is completely used. So depreciation is charged with the rate of 10%. So for 21,000, 21, 2 lakhs 10,000, 10% being 21,000. Now 2 lakhs 10,000, 2 lakhs 10,000. Balance carried on here being 1,89,000. 1,89,000. Is that okay? To balance brought down for the next period. 1,89,000. In this year, I am going to again charge the depreciation at the rate of 10% on the full value. 1,89,000. What is the amount available as written down now? That will be the base for calculating depreciation for the next year. So for 1,89,000, 10% will be created. 18,900. So close of tallying this 1,89,000. 1,89,000. Balance carried on. Balance carried on being 1,70,100. To balance brought down. To balance brought down 1,70,100. And for the third year again by depreciation on this 10% will be created. 17,010. 1,70,100. 1,70,100. After charging the depreciation, the final value being 1,53,090. Balance carried on. Balance carried on. To balance brought down. To balance brought down 1,53,090. Yeah, finish of copying this. July 1, 2014 and spent rupees 5,000 on its transport and installation. So the overall value being 45,000. The date of acquisition being 1st July. So this asset is eligible for proportionate depreciation, not for full year's depreciation. Another machine for rupees 35,000 was purchased on January 1, 2016. Depreciation is charged at the rate of 20% on written down value. Prepare printing and machinery account. Printing machine account. Okay. Okay. I assume the year end being 31st March, though not mentioned, I assume this way. 31st March. Printing machine account. Printing machine account. So we have two machines here. On 1st July 14, to bank. The value of asset purchased being 45,000 including installation charges. And the other asset is purchased 2 years later, 1st January 2016. This year gets over on 31st March 2015. 31st March 2015, I have to provide depreciation by depreciation. The depreciation here being 45,000 and applicable rate of depreciation here being 20%. Number of months eligible for depreciation being from the date of purchase 1st July to 31st March, we have 9 months, so you have to calculate the depreciation for the 9 months. This value being 6,750. Am I right? 6,750. Now, after this depreciation, the balancing figure being, you have to tally this and find out the balancing figure. 45,000, 45,000. The balancing figure here being 38,250. 38,250. In the next year beginning 1st April 15, two balance brought down. 38,250. This year gets over by 31st March 2016. But halfway through we purchase one more asset on 1st January. So 1st January 16, to bank we purchased another asset for rupees 35,000. Now for the year end 31/3/16 by depreciation. I will work out the depreciation separately here. For the asset number 1, 38,250 was used to full year, so eligible for full year's depreciation at the rate of 20%. Yes, tell me what is the value here? This value 38,250 into 20%, 7,650. Second asset also purchased sometimes later for 35,000. This will also be for depreciation, subject to depreciation, but eligible for only 3 months, as it is purchased only on 1st January, ends on 31st March. 3 months depreciation will be calculated here. So 35,000 into 0.2 divided by 4, the answer being 1,750. The overall value being 9,400. You do a working note like for calculating the amount of depreciation year after year. Straight away getting the depreciation may be a bit complicated here in the case of WDV method. So it's better to calculate separately here. 9,400. 9,400. Now close tallying this. 73,250. 73,250. Balance carried on. 63,850. 63,850. And here balance brought down. 1,416. 63,850. For the year end 31/3/17, by depreciation we have two assets now in the beginning, that all the two assets used for the entire year. So both the assets will be eligible for full year's depreciation at the rate of 20% on the WDV value. The WDV value of both the assets put together 63,850. For that 20% being 12,770. Am I right? 12,770. Now finish up tallying this. 63,850. 63,850. Here this is being balanced. The balance amount being 51,080. I'll write it down the next year beginning as balance brought down at the rate of rupees 51,080. Okay. Come on, make a note of it. Purchase being 5 into 20, 1 lakh. 100,000. Depreciation has been provided at the rate of 10% per annum using straight line method and accumulated in the provision for depreciation account. So we have to open the provision for depreciation account here. So the depreciation is not going to be adjusted in the asset account. On January 1, 2016, sometimes later, one truck was sold for rupees 15,000. On July 1, 2017, another truck purchased for rupees 20,000 on January 1, 2014 was sold for 18,000 rupees. Probably January 1, 2015. This may be wrong. A new truck costing 30,000 was purchased on October 1, 2016. You are required to prepare the trucks account, provision for depreciation account, and truck disposal account. When we plan to sell the asset, that asset is transferred from the asset account to a new account called asset disposal account. It's a transfer. While transferring the asset supposed to be sold off from assets account to asset disposal account, keep that point in your mind. Whether you are following the normal model or provisions model. In the case of normal model, no issues there, there you can directly transfer. In the case of provision for depreciation model, assets value will be now the asset sold no for that asset. Whatever the original value may be transferable from the asset to asset disposal account. Not only that, any accumulated depreciation on the asset sold since the date of purchase to the date of sale should be transferable from the provision for depreciation to asset disposal account. Two items are transferred. Okay. When the asset is charged in the depreciation, if the asset is sold, that value will be transferable to asset disposal account. At what value? WDV value, net of depreciation. When we have the asset as well as provision for depreciation both separately prepared, if some of the assets supposed to be sold off, then asset disposal account is opened for selling the asset, where the asset is also transferred to the asset disposal account, and provision for depreciation on the asset sold also transferable from the provision for depreciation to asset disposal account. The asset transferred to the asset disposal account will be showing at original value. In the earlier case, it is recorded at its own WD value because the account shows only the WD value. In the case of provision for depreciation model, asset is appearing at the original value. So, when the asset is transferred through or sold through asset disposal account, the value of the asset transferable from the asset to asset disposable account is nothing but the original value. Not only that, the accumulated depreciation on the asset sold will be available in the PD, provision for depreciation. That should also be transferable from PD to asset disposal account. Is that okay? Accumulated depreciation on this. See, it's nothing but a net of this is equal to WDV, right? Original value minus accumulated depreciation on the asset sold is nothing but WDV value. So the difference between these two models should be clearly compared and understandable. So once you understand, then you will not have any problem of these two models. In this illustration, we are following the second option. As per this option, I am going to open the asset account as well as the provision for depreciation. At the time of sale, I will be opening the new account called asset disposal account. Is that okay? Now, let's see here. Koshala Transport Company purchased trucks. Here the asset being trucks. So I open the trucks account here. Truck account. The date of purchase being 1st January 11/15. The year end being 31st December. Okay. The truck disposal account for the year, okay. Year ends on December 2015, 16 and 17. So in this case, the year ends on December 2015 or every year end being the 31st December. So they might have adapted the calendar year rather than financial year. Usually the financial year ends on 31st March, but the company may have the other than that financial year. Okay, in some cases. So, but really rare. Usually we will follow only the financial year. Otherwise, the taxation will be in trouble. So always we usually follow the 31st March being the year end. But some foreign company in their country, they might have followed some other date. If they want to have a branch in India, they may follow the parent's accounting procedure. By the time the year end may be different. So you have to understand the year end concept also. Default financial year ends on 31st March, but sometimes it may be different date also. In this case, it's December 31st, right? So 1/1/2015 asset purchased to bank. How much is that? 1 lakh. One truck costing 20 for 5 asset, it is 1 lakh. Okay. And in the same date, I have to open the provision for depreciation account also. We don't have any other purchases in that year. That year gets over on 31st December. So 31st December 2015. Okay. Of course, we don't charge the depreciation in truck account. We accumulate that in the provision for depreciation account. In provision for depreciation account, the depreciation be how much? 10% will be provided. That too under straight line method. On 31/12/15, depreciation by depreciation being 10% on the original cost. Okay, original cost. This asset, all the 5 trucks purchased the day one itself, so eligible for 1 year's depreciation, 10,000. 1 year's depreciation being 10,000. Is that clear? Finish of closing this. 10,000, 10,000. And here on the same date, 31/12/15, the balance is transferable to next side, balance carried on, 10,000. Here, 1/1/16 by balance, 10,000 rupees, 10,000. Similarly, the truck account, if I tally, 1 lakh, 1 lakh. As I have not adjusted the depreciation here, the truck account will have its own original value. So, by balance, 1 lakh. Transfer to the next year, 1/1/16 to balance brought down, the value being 1 lakh. Now, 1/1/16, this year ends on 31st March, so 31st December 2016. Meanwhile, on January 1, 2016, one truck was sold for rupees 15,000. One truck was sold for 15,000 rupees. Right. Clear? Up to this, we have completed. Forget about. We are in 2016. In this year, in the very beginning itself, one truck was sold for 15,000. So, this one is going to be separately handled. If one asset is supposed to be sold through asset disposal account, remember that assets accumulate means original value should be transferable to the asset disposal account, and that assets accumulated depreciation should be transferable from provision for depreciation to accumulated depreciation. For this asset, accumulated depreciation could be 2,000 rupees. Accumulated depreciation could be 2,000 because 1 year is used. For the 1 year, at the rate of 20%, 10%, it might have been 2,000 rupees. The overall accumulated depreciation here, 10,000 being the depreciation for the 5 assets. Out of the 5 assets, only one asset is sold. Now find out the depreciation for the one asset. The depreciation for the one asset being 2,000 rupees or 10% on the original cost of the one asset. So 20,000 into 10% 2,000. When we sell assets through the asset disposal account, where we have accumulated the depreciation in a new account called provision for depreciation, the original value of the asset transferred is also original value of the asset sold is transferable from the asset account to the asset disposal account, and accumulated depreciation on the asset sold is also transferable from provision for depreciation to asset disposal account. Now, I am transferring truck disposal account. Okay, truck disposal account. Asset sold is transferred as on the same date 1/1/16 by truck disposal account, TD account. I request you to write it fully yourself. The value being 20,000. 20,000. So here on 1/1/16 to truck account. Actually, asset is the debit balance. If the asset is sold, the debit balance should be subtracted. Then it may be credited only. Only on credit it will be subtracted. So asset is subtracted by crediting it. As it is credited, where will it go? Asset disposal account. That account should be debited. So you don't need to think beyond this. You don't need to use the debit and credit rules here. Already I taught you in this model. Assume always this is being debit. If you want to increase the debit, add back. If you want to reduce that, subtract it. Means by crediting it, it may be subtracted. So that way you can write here the value of the asset being 20,000. Always cross check whether these 2 points over. Here number 1 is over. Number 2, accumulated depreciation should be transferable. That will be available in the provision for depreciation. From here I am going to transfer 1/1/16 to truck disposal account, the value being 2000. I will be transferring that here on 1/1/16 by provision for depreciation. Provision for depreciation 2000. So very simple. If you are neutralizing that, netting it 20 minus 2, the ultimate value is nothing but what? WDV. Isn't it? Original value is 20. For the assets, the accumulated depreciation will be available in provision for depreciation. If you are subtracting from the original value, it is nothing but WDV value. Today, as per my books, it's really worth for 18 only. 20 minus 2, as 1 year is already utilized. For the 1 year's utilization, 2000 is lost. So 20 minus 2, it's now worth only 18. But when we plan to sell, we sold it for only 15, less than the value we assumed. We assumed it's worth rupees 18, but sold for only 15. So the difference between 18 and 15, 3000 rupees is loss on sale, can be now debited to the concern account. So the amount realized being on 1/1/16 by bank account. How much I realized? 15. The loss should be debited. So loss account debit to truck disposal account. So loss account also being here, loss on sale, which is 3000. By default, the asset disposal account will be closed once it is disposed. No balance will exist hereafter. Okay, sale is over. Sale is over. You should not have any confusions. It's a temporary account. We are identifying all the transactions related to the asset sold separately. That's all. So I am removing the asset sold from the asset account. If I am following the provision for depreciation model, then accumulated depreciation on the asset sold should also be transferable there. That's all. The rest of the things are the same. Now, on July 1, 2017, now for the year ending 2016, no other transaction. So I will now finish up that year. Right. So 2017 only another truck was purchased. So currently there is no any problem. Okay. On 1st July 2017, another truck purchased for rupees 20,000. On January 1, 2015, it should be 15, sold for 18,000 rupees. I keep it pending. A new truck costing 30,000 was purchased on October 2000. October 2000. Yeah, it should be 17. It should be 17. Okay, October 2017. There is error. It's not 14. This is 15. This is not 16. 17. Right. For the year 2016, no other adjustments is required. Just close it off. Okay. Now the balance of this one being 1 lakh. 1 lakh. 20,000 worth assets sold. Now 80,000 rupees worth of 4 trucks is still pending. That is called balance carried on. Transfer here 1/1/17 to balance. To balance brought down 80,000 rupees. And by the time the depreciation being 31/12/16 by depreciation, we have only 80,000 rupees worth of trucks, right? 4 trucks. So for that 80,000, you have to calculate 10%. So the accumulated depreciation for the second year being only 8,000, as we have only 4 truck. 4 truck. Is that okay? Now if I tally this, what is the balance I get? 18 here, 18 here, 18 here. 2,000 was already subtracted because that is nothing that's meant for the asset sold. As asset already sold, then provision is not required. Why do I want to have the provision? Okay, if there is a doubt of loss, then we will have the provision to adjust the loss. I am pretty sure there is no loss because already it is sold off. Once the asset is sold off, then provision is no more required. So definitely the provision should also be transferred to assets account, that asset disposal account, right? So now it is 16,000 rupees on the date 31/12/16 to balance carried on. And I'll write in the opposite side. So 1/1/17 by balance 16,000 by balance 16,000. This one is over by balance 16,000. Now we are in the last year. In the last year, on 1st July 2017, another truck purchased for 20,000 on 1st January was sold for 18,000 rupees. So when the asset is sold, automatically you have to transfer the original value from the assets account to asset disposal account. The date of sale being 1st July 17 by truck disposal account. The original value of that asset being 20. Original value of that asset being 20 should be transferable to the truck disposal account. Once again, here the date of transfer being 1/7/17 to truck, the value being 20,000, the value being 20. Okay, any asset sold, now it's your duty to transfer the accumulated depreciation on the asset sold to truck disposal account. So on the same date 1/7/17 by provision for depreciation. Remember, any asset sold, no, to the year of sale, from the beginning to the date of sale you have to provide the depreciation. Now we have to provide the depreciation, right, as on the date 1/7/17 by depreciation for the asset sold. One of the truck, original value being 20, for that the rate of depreciation being 10%, right, 10%, and it is used for how many months here? 6 months. 1st July, half year depreciation is eligible. Half year depreciation is eligible when it is sold. Yeah, July, right? Okay, then half year's depreciation, the value being 500. Am I right? Yes or no? Yes or no? Are you able to understand? One of the trucks cost us rupees 20. That 20 will be at, subject to depreciation at the rate of 10%, 2,000. Okay, 2,000, and sold on this date means you have to provide the depreciation up to the date, so which is 1,000 rupees. Sorry, it's not 500, it's 1,000, right? Yes or no? Now, when you sell the asset, any accumulated depreciation on asset sold should also be transferable. Now see here, 1/7/17 to asset truck disposal account. How much is that? This asset was completely used. Okay, 20,000. For the first year, we have completely used. This year, completely used. So for that, 2,000 rupees. This year also completely used. Second year, another 2,000 rupees. This 8,000 includes the asset sold, right? Depreciation on asset sold 2,000. In the last year, we have used for only 6 months. For the 6 months, depreciation should be now subtracted. Okay. Now the entire accumulated depreciation on this asset sold be how much? 5,000 rupees. That 5,000 should be transferable from provision for depreciation to truck disposal account. 5,000. 20,000 as on now, 5,000 is the accumulated depreciation. Today's book value being 15 only. Today's book value being 15 only. But now it is sold for how much? 18,000 rupees. As we sell more than the book value, we are really gaining. Then the record being by bank. How much I get? 18,000 rupees. The excess amount will be now a value of appreciation for the asset. So it's going to be posted in the debit side to profit on sale. Truck account is usually closed. So the value being 23,000. 23,000, it's over. Is that clear? Hope so you can understand. Now, a new truck costing 30,000 was purchased on October 2017, 1st October, right? Let's see here. 1st October 2017 to bank. Asset account, sorry. Okay, here. 1st October 2017 17 to bank. How much is that? 30,000. 30,000. Is that okay? Now you can finish up tallying this. So 1,10,000. 1,10,000. After subtracting 20 asset disposed, balance being 90 by balance carried out. Now we have to create the depreciation to be accumulated. Depreciation. How much is the depreciation? So out of 5 trucks, 2 trucks were sold. Now we have only 3 trucks costing rupees 20. This will be eligible for full year's depreciation, 10%. How much is that? 6,000. Apart from that, a new truck is also purchased for 30 currently. Eligible for 10% depreciation only from the date of purchase. The date of purchase being 110. So 110 to 31st December only 3 months. So it is eligible for 3 months depreciation. 750. So then the overall depreciation to be charged in this year being 6,750. 6,750. Now if you tally this, the accumulated depreciation you can find out easily. The value being 23,750. 23,750. Here this balance being 18,750. Balance carried out. Balance carried out. Is that okay? So now the beautiful illustration, try to understand the asset disposal model also. Try few more illustrations in this particular content, right?